putting a roof over your head without the headache. Get answers to all of your home buying questions. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
And our Sunday best to you. Good morning and welcome to the Accunet Mortgage and Realty Show. I'm Steve Kettlear along with Accunet Mortgage and Accunet Realty Advisors, owner and president Brian Wickert, and licensed millennial loan consultant David Wickert. As always, if you have a question, you can call us at 414-799-1620 or throughout the Midwest on the Accunet Mortgage toll-free talk line. That number is 1-800-877-1620. So we start off with the executive orders that were signed in almost immediately after President Donald Trump was inaugurated and sworn in.
I believe it happened, was it 45 minutes later, David?
Near instantaneous.
Yes, nearly instantaneously. And this has to do with the announcement that we made last week. Hey, good news, everybody. The mortgage insurance premium on FHA loans, this is what we said last week, is going down by 0.25%, like a 0.25% rate reduction on anybody who wants to get an FHA loan in the future and the past. Well, that's exactly what...
it lasted 1 week.
It didn't even last a week. Nobody got it.
You don't think somebody closed maybe
No, because it wasn't effective until January 27th.
Oh,
okay. And so that's what President Trump rolled back. And so I'm kind of torn. As a mortgage lender and somebody who wants to give the best deal to everybody that we can, that would have been great to lower the premium. But here's some other interesting facts that I wanted everybody to be aware of. And by the way, there happened to be an article in the Thursday Wall Street Journal. Let's see if I can quickly find the title to that. I'm going to have it here in a second. What was it? Got to get the headline. The mortgage market's $1 trillion pocket of worry.
Dun, dun, dun.
So, I mean, was that coincidence that did they maybe know something?
They were timing that out.
Maybe they were. Okay. So the article points out that there's now, for the first time ever, over $1 trillion of mortgage-backed securities. Those are pools of loans bundled together that are made up of FHA and VA loans. That is called, in the parlance of the mortgage world and actually the investment world, David, Ginnie Mae. A Ginnie Mae security. Why is it called Ginnie Mae? GNMA. It stands for Government National Mortgage Association, just like Fannie-Mae is Federal National Mortgage Association.
There you go.
So Ginnie Mae is this quasi-government entity that administers these government-insured loans. So they were talking to the top administrator, and he's given this interview in the Wall Street Journal. And
who was walking out the door, by the way?
By the way, he's walking out the door, which is kind of weird because you'd think he'd maybe be more positive if he was aligned with the prior administration. Anyway, here was one interesting fact, and this is what I wanted to drive home. Why maybe it's okay that we're not reducing the mortgage insurance premiums on FHA, because those premiums are collected in order to reimburse the investors in the event of foreclosure on an FHA loan.
It's a backstop.
It's a backstop. It's literally like a PMI company.
Yep.
You know, we have MGIC headquartered here in Milwaukee, the largest private mortgage insurance company. And you got FHA, government mortgage insurance. So the average credit score, according to this article, and they're quoting a big mortgage player called Ellie Mae, the average credit score for a FHA loan last year, 669.
Okay.
Ooh. And the average credit score for a Fannie Mae type, 30-year fixed rate loan, 743. So I turned to my cool pricing tool, proprietarily developed by Accunet Mortgage right here this morning, and I say, well, if you had a 669 credit score and you wanted government mortgage insurance, you would get today a rate of 3.75, and you would pay a monthly mortgage insurance premium. This is on a $200,000 home purchase with 3.5% down. Your monthly mortgage insurance premium for FHA, this is at the old rate, is $140 a month.
Okay.
All right. And you have to pay 1.75% of the loan balance, which is about $3,300 up front in a mortgage insurance premium, but the government allows you to finance that, so don't worry. Okay, now let's compare that to private capital. How does MGIC, how risky do they think this loan is? More than double. Okay, so private capital says, oh, instead of $140 a month, you got to pay us $307 a month.
Whoa.
Oh, and by the way, Fannie-Mae says, yeah, it's riskier too because you'd have to pay a rate of 4.25%. So 0.5% higher in the rate in the private capital world, government mortgage insurance world on sale. So you got to ask yourself, who's really evaluating this risk more accurately? FHA at their, current pricing?
Yeah.
Or the private capital folks called MGIC, and every other PMI company is priced just about the same, by the way. All right, so that's a long way of saying that maybe as a taxpayer we should be all glad that the first thing that President Trump did was to cancel the reduction in the FHA insurance premium, because that means more money will go into the fund to pay out those claims in the future, so they won't have to come back to us taxpayers to bail them out. Do you follow all that, Steve? Clear as
sure
do,
do.
Right?
Clear as me.
Yeah, absolutely. All right, so too bad for that. All right, when we come back, we are going to talk about whether or not, let's say you got a $20,000 remodeling project or home repair that you need to do. Should you get a home equity line? Should you get a second mortgage, or should you refinance your first mortgage? We're going to talk about that when we come back.
And if you have a question along those lines or anything else mortgage or real estate related, you can reach us at 414-799-1620 or throughout the Midwest on the Accunet Mortgage toll-free talk line. That number is 1-800-877-1620.
Home buying advice from the guys who know it best. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Well, why listen to Buck and Aikman during today's NFC title game when you can listen to Larrabee and McCarron watch the game at Turner Hall this afternoon while Wayne and Larry call every play? You don't want to miss the hometown call at Turner Hall. All the fun starts up at 1 o'clock today. It's free. It's sponsored by Master Z's in your neighborhood Ace Hardware stores. So we're now asking the question about, when do you open up a home equity line of credit or a second mortgage to maybe tap into your home's value instead of maybe taking cash out on a refinance?
You got it, Steve. So like everything in life, it comes down to the specific details of your particular situation. But I came up with a couple scenarios to help us quickly illustrate how you might go through this decision process. So in scenario one, Steve, we're making you the homeowner. You already snagged your trophy 30-year fixed rate of 3.5%. You're swaggering around there. You got a $200,000 balance currently. You kind of got that on a T-shirt. My mortgage rate's 3.5. Bam.
Right.
Your house is worth $400,000, and you decide, you know what? I finally got to do the roof on this thing. Maybe a couple other repairs. You need to borrow $20,000. Okay. Your choices are home equity line of credit, and by the way, you have excellent credit, Steve, 760. So on a home equity line of credit, you could probably easily get one at the prime rate plus a half. So the prime rate's currently at 3.75. Plus a half, that would make that rate 4.25. Now, you can pay as much principal as you want on a home equity line of credit, but you're only required to pay the interest due every month. So the interest payment at 4.25 would be $71 a month. All right, David, but what's the problem? Or Steve, chime in. What's the problem with a home equity line of credit? What's
you're adding to the overall mortgage balance of what you're going to owe down the road.
Correct. And what can happen to the interest rate?
It's going to go up and
up. Yeah,
it's going
to go up.
That's right. All right, but now I baited you into that, and the Federal Reserve is saying they're going to raise rates 3 times. So that would push that rate way up to the awful, awful rate of 5% by the end of the year. And on that $20,000 balance, that would make your payment go up $13.
Ooh.
No big
no
deal.
Starbucks for you.
No big deal. Okay. Option number 2 is you could get a closed-end second mortgage. And it's called closed-end because unlike a home equity line of credit where you can pay the balance down and then reborrow it again and pay it down and reborrow it like a credit card, if you get a closed-end second mortgage, that's it. Once you pay down the principal balance, you don't get to reborrow it in the future. So on that deal, I was looking at out there on the internet, you could snag a 15-year fixed second mortgage with a payment fixed rate of 4.34, not too bad for second mortgage, and your payment would be $151.
Well, you're paying it back faster and
over half that payment is principal.
Okay.
All right. So that's door number 2, Steve.
Okay.
So you want $71 variable, $151, and then here is the one you would never pick in a million years, because if I was going to refinance give you a new loan for $220,000, at today's rates, I'd have to charge you 4.125.
But wait a minute, I got 3.5.
I know. Why would you be an idiot?
Why would I
do
go
that?
back? I'm never going to do that. I have to give away the T-shirt then.
That's right. Yes, you'd have to cross it out with a red marker and say, I did something stupid. I traded it. All right,
Yeah.
you would not do that. So it's really down to either the closed-end second mortgage that has a higher payment or the home equity line. I think either one is a reasonable choice.
Sure.
Do you have a preference? I mean, there's no wrong answer, but which one would you
I
pick?
would go with the HELOC just because I could pay it down and then I could grab back at it should an emergency come up.
You got it. And maybe what you do is maybe you get a $50,000 HELOC.
Yeah.
Right? Just to have some spare change.
I actually did that on a house in Florida.
All right. Yeah, so that makes sense. Then just to quickly put a finishing touch on this, but, let's say instead of Steve, it was Mary, and Mary's rate was 4% on her $200,000 balance. She didn't have the trophy rate that Steve had. Yeah. If she had a 4% rate on her $200,000 balance, the smartest thing to do for her would be, get this, a cash-out refinance on her first mortgage on a 20-year fixed at 3.99%.
Oh, hey, there you go.
We could give her a T-shirt because her rate would start with a 3, and her payment would only go up $80 a month. Very similar, her total payment. So the answer, we get this question a lot, and I think it would be very difficult for the average person to really know about all their options. So guess what we're here for? We're here to give that kind of advice any day you want, or you can click on the blue button, of course, for a refi checkup, and that gets us started. All right, what are we going to talk about when we come back?
When we come back, I want to talk about a version of what you just said on purchases.
The
example of, maybe we'll just buy a $130,000 house and fix it up. And
can I borrow the money to do that for the fix-up?
Exactly.
All right, that's what we'll talk about when we come back.
Right here on the Accunet Mortgage and Realty Show. If you have a question for Brian or David, reach us at 414-799-1620 or throughout the Midwest on the Accunet Mortgage toll-free talk line. That number's 1-800-877-1620.
Find a place to call home without the headache. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Well, the question is, will Green Bay be packing for Houston or packing for the offseason? Matt Pauley has all the post-game reaction analysis and will take your calls tonight during Wisconsin Sports Weekend, right after our Packers game day coverage right here on 620 WTMJ. It's the Accunet Mortgage and Realty Show with Brian Wickert and David Wickert, and we're going to work in Andrea, who joins us from Hallandale. Good morning, Andrea.
Morning.
Go right ahead with your question.
Good morning. I have a question regarding a home equity loan. My husband and I currently own a home, and we owe about $185,000. The fair market value on the house is around $260,000. We haven't had an appraisal done for many years. But with putting on a roof, we want to know what would be our best option on how to borrow against to get the money to do it.
The roof is going to cost? Any estimate on how much the roof is going to cost, Andrea?
Well, no, but I would imagine it's a 2-story house, and it's, relatively large, so I'm thinking probably somewhere around $20,000.
Okay, so let's go with $20,000. And then what is the current interest rate that you have on your first mortgage?
We're at 4.25.
Okay. Then I have an easy answer for you.
Oh, wonderful.
It would be, yeah, you bet. I love it when the answers are obvious. I think in your particular case, the best option would be for us to help you take a look at increasing your first mortgage balance up to, let's say, $205,000. And the reason why that's my recommendation is you're always going to get a better rate on your first mortgage because it's in first lien position. It's the safest position to be in if you're a mortgage lender. That's why you always get a better rate on any given day on a first mortgage than you do on any kind of a home equity line of credit in the long run or a home equity loan. So we would look at three things for you. We could look at, well, actually any number of things. But I was going to say we could look at what would a 15-year fixed rate look like on the first mortgage? Maybe a 20-year or a 30-year. And actually, we can do any number of years for a loan length between 10 and 30. So we could customize it. If we were going to try to hit a certain payment for your budget, we could customize it to 22 years. All right. So there you go. That was an easy one. In your particular case, because your current first mortgage rate is 4.25%, you're in the money for a first mortgage refi. Go ahead and leave your phone number with Ben, and either David or I would be happy to give you a call tomorrow at a time that works for you. Thanks for calling into the show, Andrea. Hey, David, we got another minute.
No, and I was going to, so part of this, I had a closing for some folks on Friday, and it was a refinance, and they had decided that they were going to be paying off a second mortgage. But I got a call from the closer that, hey, they don't want to close it because they wanted to be borrowing on that HELOC soon after closing. And so I hopped on the phone with the borrower, and it was all good. And just talking through what it was that they had in mind, soon after closing on their new first mortgage with us. And it turns out that they were going to be doing a remodel.
Okay.
And so what I said to the Ryan on the phone was, well, maybe we should just increase the loan amount that you're cashing out now, because you're going to get a better rate
than getting a second mortgage.
Right. And part of it is people only know what they know.
That's right.
And so, and part of it, a loan consultant's job is to ferret out, we can't read minds, but ferret out, what you're trying to do. And so even for a roof or for a kitchen remodel, it's trying to help people understand that you're going to get the best rate on your first mortgage.
So what we should have every loan consultant ask their customers when they're doing something like this?
Do you plan to remodel anything?
Well, no, or just do you have any future borrowing needs, in the next year or two? Maybe that would just kind of be a good open-end question for you know what, we are going to have to redo the roof in a year.
Or pay for a kid to go to college or whatever.
Right. Maybe a little suggestive sell. All right. When we come back, we're going to talk about where interest rates are right now and also Fannie-Mae's most recent forecast for the rest of 2017 when we come back.
Right here on the Accunet Mortgage and Realty Show on 620 WTMJ. It's now 10:30 as we welcome in from the WTMJ 24-hour newsroom, Belinda Babinek.
Jordy Nelson, Devontae Adams, and Geronimo Allison are expected to play today. According to the NFL Network, the Packers are one step from the Super Bowl. It's Packers-Falcons in the NFC Championship game. Our Packers game day coverage starts with Packers Preview today at noon. 620 WTMJ is hosting a watch party for Sunday's game. You can watch it for free at Turner Hall in Milwaukee. The hometown call at Turner Hall kicks off at 1 p.m. Many women say they are afraid they will lose some of their rights now that Donald Trump is president. 1 million or more people participated in peaceful demonstrations for women's rights across the U.S. and around the world yesterday. The Women's March on Washington was especially large, with the crowd estimated at more than 500,000 people. Cleanup continues in Mississippi, where a tornado tore a deadly 25-mile path across the southern part of the state yesterday. Officials say 4 people were killed and hundreds of structures were damaged or destroyed in Hattiesburg and the neighboring city of Petal. William Carey University is looking for a place to hold classes. One official estimates insured damage will top $200 million. WTMJ Pella, WI.com, time saver traffic, 94 inbound.
Getting you through the home buying process. Welcome back to the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Brian Wickert with us, David Wickert is with us, and Tex is with us. He's got a question calling in from Ozaukee County this morning. Good morning, Tex.
Good morning. Thanks for taking my call.
You're welcome.
So my wife and I are building a home. Originally, we were looking at our construction loan being a single sign, locked-in rate for 30 years. And that was something we considered, and we liked the idea of not having to refinance at the end of construction. But we ended up going with a construction loan that we will need to refinance at the end. I know you don't have a crystal ball, but, how much trouble do you think it would be, looking around towards the end of that construction to maybe get some options?
Yeah, that's a good question, and I just fielded a call from somebody like this late last week. It's no problem at all, and it sounds like even if you stay with the current lender, Is that an option to stay with the current
It
lender?
is.
Or
It is an option.
Okay.
It is a smaller lender, so it would just go straight to Fannie and Freddie. But right now, the projected rate is around 4.5% when construction's completed.
Yeah. When do you think you're going to be done, by the way, with construction? What month?
June or July.
Okay. So here's the good news. We were going to talk about this a little bit. Fannie-Mae, which is the biggest thing there is in mortgage lending, they have a whole economics department. And I actually have met their chief economist, who's a regular guy. And by the way, Tex, the chief economist for Fannie Mae wears cowboy boots, even though he's not from Texas. That's kind of cool. All right. So anyway, Doug Duncan is his name, and their projection is that rates are going to be stable for pretty much the rest of the year. They're calling, for the first 9 months of the year for the 30-year fix to stay around 4.2, and then for it to creep up to 4.3 in the last 3 months of the year. So I don't think you have anything really to worry about. Now, with Accunet, it would just be a normal refinance to us. And so from a cost-effective standpoint, if you're going to be done and getting your occupancy permit, that's the key for us as a new lender, is getting your occupancy permit. We can't close until you have that and until the home is complete. We could lock in your rate, though, 60 days ahead of time. So that means that in April, if you're going to be done in June, we could lock in your rate in April for closing in June. Now, because we're new to the party, and any other lender you go to, we're going to need a new appraisal. Okay. We have to get a new appraisal, and that's probably the case. Maybe that's the only advantage to staying with your existing lender. But why do that? I mean, by the way, we have a no-risk refi program that you may have heard us advertise on the radio, where we could take a look at your plans or maybe even the old appraisal, and we would take off all the comps that were used when that was done for the construction appraisal, and we give that to a new appraiser and say, hey, what comps do you think there are for this property? So why don't you, Tex, if you don't mind, leave your number with Ben, just like Andrea did, and then David can follow up with you later today or tomorrow, and kind of get you on the calendar for April, to just kind of say, let's take a look-see then. But that's a great question. We do a lot of refinancing of construction loans. And one of the keys, though, I should mention, I don't know if Tex is still on the line or not, but if you included the driveway in the contract, and, that was part of the value, and depending on how much money you put down, that can kind of become an issue. Because sometimes what people do is like, they had the original appraisal for the construction loan, including the landscaping and the driveway. Well, that can add up to $25,000. Correct. 25, 30 grand of value. So we want to make sure we understand what was in that original appraised value when we come along to do the refinancing of it at the end. All right, when we come back from this next break, we're going to have a little bit more of a rate roundup because rates did get a little worse this past week. We'll tell you why. And then a little bit more about that Fannie Mae forecast when we come back.
And we'll try to squeeze in Steve from Milwaukee as well. You're listening to the Accunet Mortgage and Realty Show on 620 WTMJ.
Helping you find a place to call home. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
You know the guys on the field, but what about the man in charge? What led Packers president Mark Murphy to Green Bay? And how much longer will he stay in the front office? Hear from the team's president during Packers One-on-One with Greg Matzik. That's coming up at 11:07 this morning. Sponsored by Pella Windows and Doors of Wisconsin, New Generation RV, and Sound Decisions Racine. Brian Wickert and David Wickert are with us. It's the Accunet Mortgage and Realty Hour here on 620 WTMJ. Steve in Milwaukee joins us next with a question for Brian and David. Go ahead, Steve.
Hey, good morning, guys. Great show. Thank you very much for the help.
You're welcome.
I have a question. I'm looking at now. I'm debt free, no mortgage, no other loans or anything like that, and I've got an incremental right to my income over the next 5 years, about $5,000 a year. And what I'm looking at is purchasing about $150,000 worth of land, initially building maybe $150,000 to $200,000 house, and in about 5 years, I want to end up with either a larger home or a second home, so my parents could take the smaller home on the property. And I'm just curious what's going to happen, kind of a blanket statement. I don't need specific details, but you think, if I could just go ahead and afford, the 450 right now, just to do the whole thing at once and get those rates locked in, or am I okay incrementally adding on to that property, over the next couple of years?
Okay, that's a really good question. My first question for you, Steve, is how much land are we talking about?
And that's one of the questions now. Of course, I don't have any formal application right now, but I'm looking somewhere between 10 and 40 acres, depending on the location and the type of property. It's going to depend on whether it's, 5 or 15 an acre.
Okay.
So it's going to be a substantial amount of land. And from what I'm told, that it creates a little bit of a hassle in the financing process because they don't want the land to be worth more than the home initially.
Correct. And then you kind of be careful if any of the any of the land is farmable. Mm-hmm. That can also be a complicating factor. There is a company.
Oh, yeah, it could be. I haven't made the purchase yet.
You're right. Okay. So there's a specialty company that handles these more, I'll call it rural, because I think their slogan is financing rural life. And you hear them advertise in the Badger games. It's called Badgerland Financial. Okay?
Okay.
And I think they're out of like Manitowoc or Sheboygan or something like that. So they specialize in financing rural land. And
that's actually the area that I'm looking to purchase in. I work up in Green Bay and live in Milwaukee, so I'm trying to find something in between.
In between. All right. So I'm going to say they're a company like that because most banks, and we don't have any outlet for land loans whatsoever directly.
Right.
They don't like farms, because that's like, that's a specialty.
Now, I do have one option. Of course, the preliminary house plans have been laid out, so we know, where I want to be, with a $300,000 house or, a small and a medium house on the property. And then we have the option of, just initially building the smaller house. The builder has agreed to purchase the land for me and then make it part of the final loan.
Okay, that'd be cool.
So that might help me get into it. And then I'm wondering, should I just go ahead and build the monster house with the mother-in-law suite, put it on the land, and get one big mortgage? And, I'll be maxed out on my budget now, but it'll be easier in 5 years.
Yes, that would be my you know why? Because our foresight is so poor, right? Who knows what's going to be happening in the economy 5 years from now, let alone 2 years from now. And so if you have the means and the only requirement there, and you already said it though, you got to have the plans done because any construction lender wants to send out the appraiser to stand on the vacant land and then imagine with the blueprints in hand and all the specifics. So it's called plans and specs, and blueprints aren't blue anymore. They're, black and white.
PDFs.
Yeah, they're PDFs. But then you want all the detail, like, okay, what kind of cabinets are going in there, what kind of flooring, all that kind of stuff. That's what any construction lender is going to want to do because they're going to appraise the land and house as if it's already completed. So I would go for the gusto now.
The only thing that would hurt me there is because I just paid off all the existing debt and I'm currently debt-free, I also only have $15,000 in savings. So that would put me at that 3.5% or 4% down. So I'd wind up with PMI, of course. If I go with the smaller house, initially,
if they're willing to
might
do
be
that.
able to with PMI.
Do you own a house now, Steve?
No, renting. It's about $1,500 or $1,600 a month, but I probably have a $2,000 budget or so.
Yeah, you're going to have to see what Badgerland or any other rural type lender is willing to do on construction loans because sometimes they'll only do 10% down or they might require 20%. So I wish I could help you more directly, except to
that was my other part of my question. Do I want to do everything I can to avoid PMI, or do I want to do everything I can to lock in the biggest mortgage now while I can?
I would go with B in that lineup. PMI is only temporary, and so if you could get somebody to make you the big loan and get the house built and start enjoying that property now, you're better off. So good job. That's an interesting
Thank you so
call,
much.
and thanks for calling into the show and for listening. I really appreciate it. All right, so what do you want? You're welcome. All right, so when we come back, I got a story to tell from the recent past about. I got two stories. You can pick it when we come back, David, or maybe we'll let Steve pick it. Either the Illinois condo story, or I've got the story with the torturous closing. Either one when we come back.
Okay, right here on the Accunet Mortgage and Realty Show on WTMJ.
Don't break the bank to get into a house. Back to the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Brian Wickert and David Wickert are with us here on 620 WTMJ. It's the Accunet Mortgage and Realty Hour. So I don't know about you, David, but I'm leaning towards the torturous closing.
All right. See, David was just saying, don't talk about that. That's bad branding. No, I'm going to tell the truth. I'm the chief honesty officer, for crying out loud. All right, here's the story. It was a refinance, and as is sometimes the case, the husband score was 699. 1 point below the blessed 700 level, and let's say the wife's score, I think, was like 720. So in that case, mortgage lenders, just by the way, are curmudgeons, so we always go with the worst thing we can think of. Oh, let's use the lower score, right? If you have two scores, we have to go with the lower one. And so then the thing to do in order to get the best rate is, and we do this all the time, is, we just won't have the husband on the loan, right? Okay, so we're just going with the wife's better score. All well and good, but in mortgage lending, we have parameters, and one of them is how much of your monthly income are we using to service all your monthly payments? Well, now we're only able to work with the wife's income, right, because we dropped the husband, but they're both on a rather expensive car lease that they have, so it counts on her debt-to-income ratio. So we are literally at like 44.9%.
And it only goes to 45.
The maximum is 45, right? So we are like just on the edge. So what mortgage lenders do in today's modern world right before closing is we update the credit report. Wouldn't you know, she happened to use a credit card that she hadn't used before. That caused like a $50 minimum payment. Now we're at 45.2. So we call her up and say, hey, you know what, we're going to need you to pay down that credit card so we can close. She says, no problem. Does it, sends us the information. Then as we're preparing the closing documents, this was right at the beginning of January, we update the property taxes on their property, and their property taxes went up $2,000.
Ooh, went up $2,000?
Yeah, went up $2,000. This was in Milwaukee County. And so what we ended up doing there is going back and documenting some pension income that we were not counting in the original analysis. So it just, the moral of the story is that mortgage lending is very detailed. And so, and also the other moral of the story is good lenders, and I think most lenders are doing this now, are re-verifying things right at the end. So they were very pleasant about it, and we extended their rate at our cost.
Yep.
We still closed the loan at their pre-election rate of, I think it was 3.625. So it all ended well, but it was just a reminder to me, and I wanted to remind, all of our listeners, it's the devil where the devil lies in the details. That's where it is.
But the larger theme is also, if you're buying a home or refinancing, do nothing.
Stay still.
Keep your financial situation boring from the time that you start to when you finish, because we do refresh balances. And
we make sure you're still working at the same place. We haven't had that one in a while, but every once in a while we'll call 3 days before to make sure you're still working at XYZ company. It's like, no, he quit last week.
Joy.
That's a problem. You can't do that. Go ahead, Dave.
No, what's your other story? That's what I was curious about.
My other story was the person putting 5% down on a condominium in Illinois. This was your loan. You want to tell us?
Oh, this is my story.
Yeah.
You're stealing my story.
I'm stealing your story.
Well, so the interesting piece of this story was the borrower was going to put 5% down and then called and said, my employer is willing to give me a bonus of such a size that I would be able to make a 20% down payment.
It was essentially equally to almost his entire base pay.
Correct. It would be 1 year's salary. To which I was like, "You have a great boss."
Are you sure that's not a family member?
No. And so we said we can present that to underwriting.
Oh, did he have any history of bonus income?
No history.
No. So this looks suspicious to a mortgage lender. Like, what's going on here? This walks and is talking more like a gift.
Correct.
From a generous employer than a real bonus.
So
we're honest with him. You were honest.
Correct.
With him.
I said that's fantastic. We can present that to underwriting, but I'm just skeptical that they're going to bless this gigundous bonus.
I think
that times out right before you're going to buy your house.
Right. Well, and I think we probably honestly communicated we thought it had a snowball's chance in HE-double hockey sticks.
But again, I guess being on the front lines every day, people only know what they know.
That's right.
Which makes me sound like my mother. But why couldn't my employer give me a bonus. And if you haven't bought a house before,
right?
How would you know
that's
that?
Right, yeah.
That,
but he got kind of mad at us and said, "Fine, I'm going to go to a different lender."
Yeah.
But then all of a sudden, a week later,
he came back.
All right, so maybe the other lender kind of told him the same thing. That's what we suspect. Hey, I got to give a little 60th birthday shout out to Jim Wozniak, regular listener to the show.
Yeah.
He turned 60 this past week. Had a big party at his house.
Nice.
Saw a lot of our customers over there. A lot of people listened to the show. Said nice things about you, Dave.
That's
Somebody said, "Oh man, I really loved it with your son on the show." So
if I can give a shout out too, I was in Jesus Christ Superstar at Greendale Community Theater. So a shout out to my castmates. We wrapped up last night, and as I said, they were terrible for my liver, but good for my soul. So
oh wow,
it was a good run.
It was a community theater. Yes. No students were involved. No underage personnel were involved.
Very true.
Making of that show. All right. Well, hey, we're hoping that we'll be celebrating a Packer trip to the Super Bowl next week when we do our show, and we wish them good luck. So until next week, Steve, all the listeners got to do is click on the blue button to get started with their rock-solid pre-approval to buy or a refi checkup. That's all we got. See you next week.
Right here on the Accunet Mortgage and Realty Show. Straight ahead, Belinda Babinek joins us from the WTMJ 24-hour newsroom.
The preceding was a paid program. Advice and opinions expressed during the Accunet Mortgage and Realty Show are solely that of the hosts or guests of Accunet Mortgage and Accunet Realty Advisors and not WTMJ Radio or Scripps Media Incorporated.